Joining us this afternoon for a bull-bear debate on tech, Dan Ives of Wedbush Securities and Charlie Babrinskoy from Ariel Investments. Good afternoon, guys. Good to see you both.
Thanks for having us.
Great to be here.
Let's just set it up, Dan. You basically think you've been bullish on the tech sector, but your broader point is that the results that are coming in from Q2 sort of ratify your view.
Yeah, fundamentals. If you look at earnings season, I mean, from Microsoft and cloud to cybersecurity to stalwarts like Apple, and I think even you saw with Palo Alto last night, I mean, fundamentals holding up a lot better than feared. And that's really our thesis, is that ultimately as this plays out, there's going to be a bifurcation in tech. But I still believe that this is ultimately a second half. It's going to be tech stocks in the green, especially with a lot of the bearishness out there that we're seeing.
We're going to talk more about Palo Alto in a second, but Charlie, broadly speaking, is the pushback the notion that the market got overexcited about the rate cycle slowing down and hence got too excited about tech?
Well, it's benefited. Tech has benefited from lots of tailwinds over the last 2 years. Broadly speaking, tech stocks did very well with COVID, the Pelotons, the Zooms of the world, and have really benefited from an historically unprecedented low interest rates. Low interest rates help tech, help growth much more than value stocks. So now, as Buffett says, when the tide goes out, we see who's been swimming naked, and we got a lot of tech stocks that look kind of unsuited here. So they've had a lot of tailwinds. Now we're starting to see how they're going to do in a normal environment.
What about the notion that we're in some sort of structural, innovative cycle where really the macro cyclicality is going to be meaningless in the grand scheme of what technology brings to our lives and earnings?
So I'll take that one. People always say that about tech. People, whenever you're in the 70s or the 80s, it's the mainframe computer that's going to change the world. It's changes in transportation. That's why tech stocks always trade for massive multiples. And yet for the last 100 years, value stocks have beaten growth by an average of about 3%. Why? Because everybody always wants to own the glamorous growing company, and they don't like to own that steady, stable cash flow company. Everybody has the dream of being the next Facebook or the next Apple, and often that dream doesn't come true, which is why value has outperformed growth by so much.
What do you say to that, Dan? I mean, people talk about the Fed, and who knows what Powell will say on Friday, but bottom line, 8.5 CPI is a long way from 2, and if we do have that long road ahead, isn't there the chance that tech stumbles in the midst of it?
Look, I think there's going to be names like Zoom, DocuSign, and some others that stumble, and some of the work from homes. But when I look at cloud, we're still only 40% of the way through. I mean, I think it's a fourth industrial revolution that's playing out in cloud, on cybersecurity. You look at Rock of Gibraltar's like Apple, even going to iPhone 14 cycle, where our checks coming out of Asia continue to be robust despite the macro. So I think it just ultimately shows really what's going to be a bifurcation of tech. You got to own the right names. But I think right now, in terms of sentiment, it continues to be as negative as I've seen going back to 2009, 2010, even despite some of the rally that we've seen over the last month.
That's interesting. Charlie, some of the names that you mentioned that were COVID beneficiaries, right? Peloton, Amazon, Netflix, Zoom. I don't see a lot of enterprise names in there, and I wonder if your thesis extends to the possibility that we do get a drawdown in business investment, where enterprise really becomes the locus of any weakness.
Yeah, very possible. I mean, I should be careful and say there are some tech names that I think are reasonable valuations and will do fine. Oracle has a big enterprise business, and they have a big hosting business that is reasonably priced at about 14 times earnings. But a lot of these names just aren't. Fundamentally, you have to go back to valuation. And I know that's boring, and I know a lot of growth investors hate to talk about valuation, but it really does matter. And we have a lot of technology names that have valuations that are unhinged from the fundamentals. And the reason they've been able to survive in this world is because we had negative real interest rates. In a negative real interest rate world, $1 of earnings 10 years from now is just as valuable as $1 of earnings next year. That's going to change.